Ever wonder how you can really know what's going on inside a business? I'm not talking about marketing or headlines. I'm talking about the real story. Well, what if I told you any business, big or small, tells its entire story through just 4 key documents? They're written in the language of numbers, and today, we're going to learn how to read them.
It kind of feels like a puzzle, doesn't it? How can 4 totally separate pieces of paper paint one single coherent picture of a company? Well, the secret is that they're not separate at all. They're all connected, flowing into one another in a really clever way. And we're about to see exactly how that works.
So, here's our game plan. We're going to start with the most basic question of all. Did the business actually make any money? Then we'll find out what happened to that money. After that, we'll take a quick snapshot of the whole company, and finally, we'll follow the actual cash. By the time we're done, you'll see how it all fits together like a perfect puzzle. All right, let's dive into Chapter 1, the income statement. This is always where you start because it answers the most fundamental question in business. Over a specific period, like a year, did we win or did we lose? That's its whole job. Seriously, it's not worried about how much cash is in the bank or what fancy equipment the company owns. It is laser focused on just one thing: profitability. Did the company's activities, over a set amount of time, result in a profit or a loss? Simple as that. And the formula behind it is just beautiful in its simplicity. You take all the money the company brought in, we call that revenue, and you subtract all the money it had to spend to make that happen. We call those expenses. Whatever's left over, that's the famous bottom line. Okay, let's make this real. Imagine we have a little coffee shop. We'll call it the Explainer Cafe. Over the year, they sold $50,000 worth of coffee and pastries. Awesome. But it cost them $40,000 for rent, beans, and paying their baristas. So you do the math. 50 minus 40 leaves a profit, or net income, of $10,000. Super clear, right? Now, this $10,000 number is everything. It's our first critical piece of information. I want you to think of it as the very first domino we're going to push over. So lock that number in your head because it's about to kickstart our entire story. And before we move on, here's a fantastic way to think about this. That income statement we just saw, it's like watching a video of the cafe's entire year. All the sales, all the costs, the whole story. But the balance sheet, which we'll get to in a bit, that's different. It's like taking a single photograph on the very last day of the year. It's a snapshot in time. So let's move to the next chapter. We know the Explainer Cafe made a $10,000 profit. Great, but where did that money go? Did it just sit there? Did the owner take it home? This next statement tells us exactly that. This one is all about the owner's piece of the pie, or what accountants call equity. It's a simple report that shows us how the owner's stake in the business changed from January 1st to December 31st. Did it get bigger? Smaller? Let's find out. And boom, here's our first big connection. See that? The $10,000 net income from the first statement flows right into this one. We add it to what the owner's stake was at the start of the year. Then we see the owner took out $2,000 to pay themselves. We call those dividends, so we subtract that. And that leaves us with our new updated ending equity of $108,000. This is our second key number. It represents the new value of the owner's stake in the company. And just like before, this number is the key that's going to unlock the next statement. All right, remember that photograph we talked about? It's time to develop it. We're moving on to the balance sheet. This is that snapshot of the company's entire financial position on one specific day. What it owns, what it owes, and what's left over for the owners. And it's all built around one of the most famous equations in business: assets equals liabilities plus equity. In plain English, that just means everything the company owns has to be equal to everything it owes to others, plus the owner's own stake. It's not a suggestion. It has to balance. That's the whole point. And here is where the magic happens. Look at that. See that $108,000 on the right side of the equation? That's the ending equity figure we just calculated on the last statement. It slots perfectly into place here, showing that the company's $158,000 in assets are perfectly balanced by its debts and the owner's updated stake. And just like that, it all clicks together. The profit from Statement 1 updated the owner's stake in Statement 2, which then made Statement 3 balance perfectly. But there's still one nagging question left. So wait a minute. This is a question that trips up almost everyone. If the cafe made a $10,000 profit, shouldn't the cash in its bank account have gone up by exactly $10,000? Well, not necessarily. And understanding why is the key to our final and maybe most important statement.
And that brings us to our final chapter, the one that tells you what really happened with the money. The statement of cash flows is designed to do one thing and one thing only: show you exactly where the cold, hard cash came from and where it went.
See, the reason profit isn't the same as cash is because of a core rule in accounting called the accrual principle. All it says is you record revenue when you earn it, not when the cash actually hits your bank account. So if our cafe caters an event and sends a bill, that's revenue, but they don't have the cash yet. The same goes for expenses. They might get a bill for coffee beans today, but not pay it for 30 days. The expense is recorded now, but the cash is still in their account.
This is why the statement of cash flows is so crucial. It was literally invented to be the bridge that connects the profit we saw on the income statement with the actual change in cash in the bank. It reconciles everything and shows you the real money trail. And it does this by neatly sorting every single dollar that moved in to one of three simple buckets. Cash from day-to-day operations, selling coffee. Cash from investing, like buying a big new espresso machine. And cash from financing, like taking out a loan or, hey, paying out that $2,000 dividend we saw earlier.
Okay, we've gone through all 4 chapters of our financial story. Now, let's take a step back and watch how they all link up to give us the complete picture, the full narrative of our little cafe.
And this right here is the whole story. It's like a waterfall of information. It all starts with the income statement, which gives us that key net income number. That number then flows down to update the owner's stake. That result then flows down to the balance sheet, making it balance perfectly. And finally, the cash flow statement comes in to explain exactly how the cash on that balance sheet changed from the beginning of the year to the end. It's a perfect, closed-loop system. And that, right there, is why this all matters. Learning this flow isn't just some boring accounting exercise. It's about empowerment. It gives you the ability to look past the headlines and see what's really going on inside a company. Whether you want to be an investor, a business owner, or just a smarter manager, this is the language you need to speak. So the real question is, now that you know how to read the story, what kind of decisions are you going to make?